And welcome everyone to another Smart Money Circle episode. I'm Adam Sarhan. With me today is John Tinsman, who's the founder of AOT Invest LLC and portfolio manager of the AOT Growth and Innovation ETF, ticker symbol is AOTG. He's also going to be launching AOTS soon. But John, thank you so much for coming on the show and taking the time. Welcome to the Smart Money Circle.
It's a pleasure to be here. You have a great show, so it's an honor to be part of it, Adam.
Well, thank you kindly, John. So I always like to begin. Can you please tell us your story and how you got to where you are today?
Yeah, so my story is really just of providing good investment advice and good performance over the long run. So I uh, I grew up in Iowa. I went to Northwestern and University of Oxford. I studied economics, took as many investment classes as I could, and I've been investing really since I was pretty young, like in high school. And at the same time, my family has a fertilizer company in Iowa. And so I've gotten a very good, developed a very good, I think, management experience in a value oriented like business, like fertilizer. And at the same time, also simultaneously developed investment experience by investing my own money and then eventually the rest of my family's money. And then as that continued to grow, launched an ETF and AOT Invest and began managing money for the general public. And you know, like any investment journey, it's really about trying to learn as quickly as possible what works and what doesn't work. And so, what I really came back to and what my unique strategy was is to focus on profitable, high growth companies that have low marginal cost characteristics. And so, I don't know that there's anything in the market like that today, but how I really formed that myself was basically taking a look at my portfolio. And when I was doing this in 2010, right, there was names that I was buying like Boeing and Ford and 3M and GM, and these names were over the past 15 years are really only up 100%, I think, on average. Meanwhile, other names I was buying, like Visa, which is technically financial services, or Google, which is communication services, or Microsoft, which is information technology, and NVIDIA. These names are up 2,000, 5,000, 50,000%. Okay. And, Apple, Google, Microsoft, those were big companies back in 2010 as well. So I'm not trying to cherry pick the best ones, but what I noticed is Google, Microsoft, Visa, these companies have low marginal cost characteristics, right? So these companies are things where one additional unit costs them nothing. When you swipe your Visa credit card, it's not like they have to build another airplane that costs $100 million. No, like it's 100% profit margin for an incremental sale. Same thing with when Microsoft sells one additional unit of Microsoft Office, or when Google, when you want to go advertise and you do a Google AdWord, that is pretty much 100% profit margin for incremental sales. So the flip side of this is Boeing and 3M, right? These are companies that have to build the product again. Even a fertilizer company like us in Iowa, you have to build the product again. It's very expensive. You have very slim margins. And so it's no surprise that these companies that have low marginal costs can scale faster, reach instead of a 1 or 2% profit margin. I like, right, Nvidia is selling their chips at a 70% profit margin. So they have a profit margin that's 30x higher. They can scale without any debt, right? So they don't need to build a new factory, a new retail stores. They just, if the demand's there, it sells. And so this is something I think that's safer for investors in the long run. I think that there's way more upside, right? Not only is there higher growth, but the growth comes at 100% profit margins. Um, so so I realized this myself. I saw it in practice in my family business where fertilizer, it's very difficult to scale. It's a knife fight, right? If you win business, you have to steal it from somebody else and nobody wants to hand it over. So basically like the profit margins are a lot slimmer and growth actually usually comes at negative profit margins. So so basically, I took all of these personal experiences and just said, well, if that's my personal experience, why would I continue to invest in the traditional industries? If I think I can make over 15 years 30x more, 40x more, that's a ton of money more. I mean, if you had $10,000, that's like the difference between having 20,000 or 400 or 600,000 15 years later. So I was like, if I can continue to do this over a long period of time, I should launch an ETF, do it in a tax efficient wrapper where you don't have to pay capital gains when you turn over the portfolio, and basically just create a really good investment vehicle and have it be public so that people can see the results, and see it, and anybody can Google it. And so now it's been out for 3 years, right? It ended, October 31st. I think it was up, 130% plus in 3.5 years. So this has been one of the best growth funds in the market. And and I think what else is unique is that in my research, and one of the reasons why I launched this and didn't just buy other people's growth funds, is that I saw all these high growth funds. So these are companies that generally their portfolios, their revenues growing at 20% year over year or more. So this is a lot higher than a traditional growth fund. But what I saw is that they often were mainly unprofitable companies, Adam. And the problem with unprofitable companies is that you just have a lot of losers. And I thought, well, like instead of, maybe you miss ones like Amazon, right, when they're unprofitable, but if you're investing in Google and Microsoft when they're making money and doing buybacks, you don't necessarily lower your returns. The returns are the same, but you lower volatility quite a bit. So I generally try to invest in profitable companies. I believe this lowers volatility, but keeps the performance the same. And so, or even better. And so when you compare AOTG to other high growth funds, you'll see, like, look at the top holdings. It's mainly blue chip S&P 500 companies. So I think it's a really unique take on high growth that doesn't exist out there in the market, to my knowledge.
I love that. By the way, everything you're saying here, I'm taking notes as you're speaking. It makes perfect sense. Where I've
Yeah,
had similar observations in the growth investing phase, and look at breakouts and can slim stocks or growth stocks, whatever it is, and you could break them down almost like you said. There's profitable ones, unprofitable ones, and then the low marginal cost businesses, SaaS-based businesses, the online stuff where the incremental cost is extremely low. Like you said, Visa's not paying $1 billion to manufacture a new factory in jet or whatever it is for
yeah.
each additional swipe or credit card or American Express, whatever. I think it's genius. So it's actually brilliant. So hats off to you. Super, super well done there. So you spoke about yourself and the background, and I've interesting you mentioned fertilizer. Just last week, I interviewed the chairman of the board at Grow, which is a Brazilian potash company, and they're feeding the world and doing fertilizer as well. So it's interesting you showed up as well. But I love what you learned there from your early years too, how you took that and applied it to investing, where you can't really scale the fertilizer business with low marginal costs, or the incremental cost to scale that is it's a lot more than just swiping the card and that's it. So I love that fact that you saw something, there was a problem in the business growing up, and you said, okay, other businesses don't have this problem and they also are profitable. Let me go there. And it's a great way of pivoting and adjusting. So great job there as well.
Thank you, Adam.
So, all right, next question. You spoke about the business, spoke about the strategy. Anything else that you want to share with the investment strategy before we move forward?
I mean, I think that one of the other things that's unique about it is that a lot of people compare it to indexes, right? And so indexes weight by market cap. So you might have funds that are growth indexes, like the Vanguard Growth Fund or the Charles Schwab, Growth Fund. And so, like a good example is if you have a company like Palantir, which AOTG doesn't own anymore, because AOTG is sensitive to valuation metrics. And so that might be trading at a price to sales of 100. And then you might have a company like AppLovin, which is trading at a valuation metric of one-fourth the amount, right? And so based on revenue, and it's a more profitable company that's actually growing faster. And so I think what's interesting about AOTG versus an index is, like, if you were investing with your own money and somebody said, "Hey, do you want to invest and buy this company that's 100 million or this other one that's growing faster and is more profitable for 25 million?" Everybody would choose the $25 million software business over the 101 that's growing slower and making less money. So I think the interesting thing is a lot of people have a hard time stepping outside of the index. But AOTG really does that. I mean, look, I put all my money in my own fund, right? So I'm very committed and believe in the strategy, but it offers a unique take, and there's some ways active management can help. And I think in one of those ways is investing in high growth, but at the best valuation metrics, instead of just blindly throwing your money at the most expensive companies in the market, regardless of their profitability or their sales, which I think in tech is particular. It's not necessarily true in the whole market, but in tech and high growth tech, it's very, I think, necessary to help performance.
Yeah. No, it makes perfect sense. Thank you for that clarification. So moving forward, let's talk about risk management. How do you handle risk, and what are some mistakes you see people make with respect to risk management?
Yeah, so I mean, you've seen funds like ARKK, right? ARK Invest, and they lost like what, like 80% in the drawdown, right? And I think part of that is that it's speculation. And there's other funds I think like out there that are saying, oh, we're going to invest in all this Ethereum infrastructure and stuff is like a like the granny, does that. And but like I think what's interesting is like there's no speculation in AOTG, in my opinion. AOTG is really about investing in the innovation today, right? And so, what's the best metric for innovation? And it's not some company saying, hey, we're going to cure sickle cell anemia, or we're going to cure cancer, or we're this product with this unproven service and no revenue, but trust us in 5 years, it'll be there. No, the companies that are innovating the most today are the ones that are growing their sales the most. People are saying we can't get enough of this product. We need more. Companies like Nvidia. And so to me, when you have an innovation fund and a growth fund and you're not including the most innovative companies in the United States that are also happen to be the fastest growing and the most profitable, to me, that's a bad take on innovation. So to me, I'd say the long term, and there's always going to be a little bit more volatility in things that are going up a lot, right? Because there's going to be price discovery to the upside, and there's also going to be a little more price discovery to the downside as the market says, hey, we have a company like Micron, it's gone up 80% in the last month, and maybe we're going to see 20% down as the market's trying to figure out what it's worth. And so I think there's always going to be a little higher volatility, but in the long run, focusing on the companies that have the highest revenue growth and the highest gap uh, earnings per share growth. And that in the long run means that the valuation metrics, if the stock goes down or it doesn't go up at all, the valuation metrics are falling like a rock, right? So you got a company that's growing their, earnings like, AppLovin at 100% year over year. That, I mean, if the stock falls, and it grows its earnings at 100%, you're going to see valuation metrics plummet. And that actually, I think, lends a lot of support. The other thing is investing in companies with very strong buybacks. So the market sells off, Google, Microsoft, whatever, Nvidia, AMD, they're out with their humongous multi-tens of billion-dollar buyback programs. And those companies, like in 2022, during that pullback, went down much less than ARK. A lot of them only went down 30% or less. So I think that provides a lot of safety and risk management. But at the end of the day, this is not like a hedge fund that's like buying puts or something. So it is a long-only equity fund, and there's always downside potential in long-only equity funds.
Understood. Okay, thank you for that clarification. Let's talk about timeless lessons you've learned along the way that you'd like to share with the audience.
Yeah, so my timeless lessons, I generally avoid small cap companies, right? So all the research is out there. It's like if you just take it as a whole, I mean, you could go on to Morningstar and look at like the 10-year charts of like the sectors. Large cap growth beats all the other sectors and technology beats all the other sectors, right? So if you have like a small cap value fund that doesn't do as well historically, and that's over 5 years, that's over 10 years, that's over 25 years. I mean, so the question is like why? And I used to invest in more small cap companies because I think there's something that's like appealing of, oh, this is going to be the next big one. And a lot of these companies market themselves really hard to investors of like, hey, we're going to, invent this great new product. I think the problem though is that like you have a management team and they're making $100 million a year. And that just, it might be 30% of the revenue in stock-based compensation. And that just takes all the upside off the table. You know what I mean? Like the management is making all the upside on average. So you have these companies that don't provide much, that have all the downside risk and more because they're not nearly as proven or reliable, but they take a lot of the upside off the table with very high stock-based compensation and very high management pay. And the management team is making as much as the people at Google and Microsoft. And you're like, well, meanwhile, Google and Microsoft aren't diluting their shares. They're buying them back and taking 4% of the shares out of the circulation every month or year. So, like, there's just, you need to overcome that hurdle when you invest in those small companies. And I don't think you can even come close to doing that.
Yeah, no, I
Other
love that.
timeless things, I
Yeah,
mean,
please go ahead. Yeah.
yeah,
Yeah.
I mean, I think it's important to if there's a lot of investors out there that like to turn over their portfolio a lot, and I'm actually not one of them. Like I really focus on long-term buying and holding, which there's a lot of active funds that really have a lot of high portfolio turnover. So I mean, like people like Warren Buffett, though, on the other hand, like that would obviously be an active investor, and he's not turning over the portfolio very frequently. So I mean, to me, I don't see like a lot of data there that is a repeatable strategy. And so like when I invest, I try to focus on what's repeatable. What not only what is simple enough that you can't mess it up, and like large cap growth technology investing is like it should be hard enough to mess up, right? But but also like what's repeatable. And so like low marginal cost and high growth at reasonable valuation metrics. It's a very simple strategy that makes it very repeatable and it makes it like back testing on it very easy, like things like that. So you have a lot of data that you can use to say, hey, this is what's worked in the past. This is why we believe it'll work in the future, right? Growth that comes without debt, high growth, growth that comes at 100% profit margins. It's somewhat predictable when you see a company, let's just say a company like Toast and they're growing and, you say, okay, well, they're only making $100 million, but when they add another billion to their revenue, that could come at close to 100% profit margins and their net income is going to go up by 400%. And they did like in the last year. And so those I think offer really good opportunities that is somewhat predictable, that's a repeatable, simple strategy. And I think those high turnover portfolios where some people look and they're like, okay, like I'm going to move into healthcare when it's hot and I'm going to move into financials and I'm going to move into oil and they're all moving around. Not only do they recognize a lot of taxes, which destroy the efficiency of the strategy, but they also, I think it's not repeatable and I think it probably destroys more values than creates in the long run.
Yeah, no, that makes sense. Thank you for that. How about the flip side of that? Timeless mistakes. How do you learn from them so you avoid them? Don't repeat them.
Yeah, so I mean, timeless mistakes, it's a great question. Um, I would say that I mean the investing in unprofitable companies. Okay, so I'd say that a lot of people think that there's a lot of successful stories like Facebook and Microsoft, and you can go down the list, right? There's all these companies that at one point were unprofitable, and if you had invested in them then, you would have made more. But they kind of leave out the point that it's like, look, if they turned profitable in 2000 and you would have invested in Apple then, like you also made just like you made a ton. Maybe you missed out on the first couple of years. So I think I don't really invest in unprofitable companies. So when a company, in my portfolio turns unprofitable, and they sustain that unprofitability for multiple quarters, generally I'm taking it out of the portfolio and replacing it with a profitable one. The companies that are most likely to be profitable in the future are the ones that are already profitable today. So I would say that. And you significantly lower your risk in a downturn, in a recession. People have no idea how to value unprofitable companies, or when there's a lot of panic that hits. So whether you're talking about the Trump trade talks, or you're talking about the COVID correction in 2022, or you're talking about the dot-com bubble, these are all times when it would have been really hard to hold an unprofitable company, and you would have lost a lot more. So I think like you have some very big wins when you buy unprofitable companies, but for every big win, you also have like 5 or 6 losses. And I think that if you focus just on profitable companies, you can have, like you can see in Nvidia, you can have bigger wins. Okay, so you have bigger wins, but at the same time, you really don't have very many losses. Like if you had just bought Nvidia and Microsoft and Google and Robinhood or whatever, all these profitable companies, even like Coinbase and stuff, like in general, the portfolio doesn't really have any losers. And so, like, I've had some losers, of course, over the last year. Like, Salesforce has gone down. I believe Adobe's gone down. But the losers are really pretty small. At the same time, you have big names like Robinhood and AppLovin that are going up by 400+% in a year. So I think that's a very, that I think it creates really favorable risk reward dynamics as a whole when you're doing the average of the portfolio.
Yeah, no, that makes sense. And again, if you're not frequently turning over the portfolio, even if it's quote unquote down, but it's still a profitable company and checks all
Yeah.
the other boxes you look for, you're not selling it, so you don't care. It'll come back
Yeah.
eventually.
And
Yeah,
I'd say
makes
the
sense.
other mistake is that when you cut the highest growth in your portfolio is usually a mistake. So, like, say Nvidia is going up and it's gone up by 1,000%. There's a lot of investors that sit there and say, "Oh, it must be overvalued now." Not to mention, by the way, that it's earning 18 times more than 2 years ago. So it's earning 1,800% more. But they say it's time to cut it, and it's like, okay, but if you cut it and you buy companies, I don't know, like a mining company or if you buy to those traditional industries like Procter and Gamble that have no growth and no earnings growth. And To me, that's not like you never want to have a portfolio metric that lowers your growth, and you never want to have one that raises your valuation metrics. Okay. So as a whole, when you do turnovers and you're revising your portfolio, I think like if you're going to sell Nvidia, you'd want to buy a company like AppLovin, which is growing faster and maybe has a slightly better valuation metric. So if you could lower the valuation metrics and raise the growth, now that to me is a long-term win. So like when I'm turning over the portfolio, and I'm, say Spotify turns unprofitable, so I'm reducing the weight very significantly in Spotify, which I just did in this last rebalance. It appreciated by 600% in the portfolio. I'm reducing the weight. Then I'm going to, where am I going to put this into? Well, Micron a few months ago had a price to sales of 3, which was 40% of Spotify's. Well, it had 7 times the revenue growth, and it had like 10 or 12 times the earnings growth. So to me, that you're lowering the PE, you're lowering the price to sales, you're raising the portfolio revenue growth and the portfolio earnings growth. Now that is a win in the long term. And I'd say when like the things to avoid is doing a rebalance that hurts the metrics, and the things to really target is rebalances or in your changes in your portfolio that do all the things it should.
Yeah, thank you for that clarification. That's really important because if you trim the winners, you're not going to ever have those 400% gains that more than make up for those small losses and then some several times over. So
Yeah.
yeah, I that natural tendency to do that. Okay, let's talk about leadership. What makes a great leader? And anything else you want to speak about leadership, please?
Yeah. I mean, I think a great leader needs to be self-reflective, right? So they need to always be looking and saying, like, what does, you know, you have to be honest with yourself. Like, how have I done? And if you don't realize you're doing things wrong, you don't realize that you've made mistakes, you can't ever avoid continuing to do it. So a great leader needs to have the right self-reflection to change course when they need to quickly, because you don't want to lead people down a cliff, and you also don't want to not be the leader that you can be. And so I think just being honest with yourself and striving to always do what's right. I mean, when you have a business, right, your attitude needs to be service and hard work. So like you're there to serve others, and the other people aren't there to serve you, right? So you've got your customers, and it's not their job to make your life great. It's your job to make their life great. And so I think the focus on to be a great leader, right? Like you don't want a leader that runs around saying like, you guys need to be doing more for me and making my life easier, blah blah. Like you need a leader that is focused on doing right for others. And that is what a leader is. A leader puts themselves behind who they're leading. So they place a right, like Jesus Christ was focused more on helping the people he was trying to help than having a great life himself, right? And so that's a great leader, and I think that should really the focus on service of others and hard work is. And the worst leader is probably somebody that wants to relax all the time and not serve anybody else, right? So not a person most people want to follow.
I love that. Okay, so being successful, people have to overcome adversity and obstacles. How do you handle adversity, and what are some obstacles you had to overcome along the way?
Uh, You know, I would say that I mean, I'd say an obstacle is that when you're starting out early, you're always going to have to work for some people you don't like. And and by the way, like to be excellent, it takes a lot of discipline and hard work, right? So if you're going to try to go to top schools and you're going to try to work in very competitive industries, things like that, like this takes an enormous, if you're trying to going to be a top athlete, things like that, enormous amount of dedication and enormous amount of hard work. So you've just got to buckle up, and then of course, and be willing to put in the time that it takes to get there. Then, I mean, the obstacles is you can't let them not persevere, because the world's full of quitters, and you have to be somebody that perseveres. Like you are, when you believe in what you're doing is the right thing, you should never give up. And so if you believe you're on the right path, whether it's with your investment strategy or whether it's with your in your personal life, things like that, like you just don't give up. You keep fighting till you win. And so I think it's pretty important to know when you're and to have the perseverance that's required to make it to the top, and that way it puts you in a position to be able to do the most you can for others.
Yeah, no, I love that. Okay, so final piece of advice that you'd like to give the audience or your 30-year-old self.
Yeah, well, I'm 31, so I
Let's go
look
20.
back
How about
and
this? Let's go 20-year-old self. You said 10 years ago, and you said investing early in 2012. I was like, all right, maybe he's over in the late 30s, but let's go 20-year-old self.
Yeah, so I mean, I would say that w- I think the most interesting thing, and this is probably the most applicable for people that have their own business, is doing what's scalable, right? So like you have a business and you want to do something that you're passionate about because that makes the hard work seem like it's not hard work. And that's pretty obvious, but you want to focus your time and energy in something that can scale. So like you might be like, you know, trading currencies or something, 10 times leveraged. And like we'd both look at each other and be like, well, that's not scalable because there's not that many people that want to give you their money to do that. And there's not that many, like there's a lot of risk that's involved and things like that. So like, how can you help the most and have the positive impact on the most amount of people possible for the littlest amount of work, you know. And of course, you're going to be working hard either way, but the amount of incremental work for each additional person. And so now we're kind of coming back to the low marginal cost. But I think the sooner people can realize that on their life, like what can I do that allows me to help the most amount of people? Just like you have this show, like 30 years ago, you couldn't have done that, like unless you were on television. And 100 years ago, you would have to be like writing a newspaper column or something. But now you can reach hundreds of thousands of people more every week with your show. And so like you're doing something that's very scalable that can reach everybody that's interested in it. But like imagine if you like had this show, but you just wanted to like, you weren't doing it in the format you were doing it, and that it wasn't nearly as scalable to reach and have the maximum benefit it could. And so I think it's really interesting, like people like Elon Musk, like could recognize the scalability of the payments industry with PayPal and with like the satellite industry with SpaceX. And so he really like I think it's important to look at like what's the marginal cost when you reach that scale and what's the most scalable and the most realistic. And so that's I think good advice for everybody, considering their career and their and whether they start a business, things like that.
I love it. Well, John, we'll scale this to the moon, hopefully. Thank you so much for coming. Yeah.
Yeah.
Congrats on all the success, and hopefully we'll have you on again soon. This is absolutely fantastic.
Yeah, so thank you so much. And if you guys want to learn more about AOTG, you can visit the website at aotetf.com.
Yeah, I'll have that in the description. Thank you very much. I'll have that in the description. The ticker symbol it was mentioned before is AOTG. AOTS is coming out soon, everybody, so feel free to check that out as well. And the link will be in the description. All right. Thank you so much. Have a great day.